Hi, I'm Jeff Helsden. I'm a lawyer in Gig Harbor, Washington, and I've been facilitating 1031 exchanges for over 28 years now. I want to talk to you about a question that I often get and have gotten over the years about the 45-day identification rule. It's one of the most misunderstood parts of Section 1031 from a client standpoint. And in fact, just this past week, I had a call from a client who has already closed his relinquished property, and he intends to acquire one and only one property in the exchange. We're about to come up to his 45-day identification deadline, and he's got two properties that he wants to identify. The primary property that he intends to purchase, and then a fallback property just in case he's unable to close the intended primary property. So his question is, well, I'm going to be buying down in value, so there will be cash left over from the cash that we have been holding from the closing of his relinquished property. And after he closes the one and only one property that he intends to acquire in the exchange, can we just then wire the balance of the funds to him? After all, he wants to do some remodeling of another property that he owns because he's going to do a second exchange. And the answer to that is, if there is another property on his identified list, if he has two on the list, and the 45 days has come and gone, even though he only intends to close on one property, even though he has only closed on one property, the facilitator cannot, under the law, disperse the balance of the funds that the facilitator has been holding until the end of 180 days from the closing of the relinquished property. Immediately after he closes the first replacement property, even though he doesn't intend to acquire any more, the facilitator cannot disperse those funds because the IRS deems it to be an open exchange. And if it's an open exchange, then as far as the IRS is concerned, the taxpayer, my client, still could acquire a second piece of property. So since the law requires for the facilitator to hold the funds from the closing of the sale or relinquished property during the entire exchange period and not allow the taxpayer to have access to the cash, to have access to the net proceeds, if the facilitator were to do so, and if I were to disperse to him the balance of the funds, let's just say that maybe there's $20,000 left that he wants to be able to use for his own purposes to help fix up another property. If I were to do that when he has another property on his list and the 45 days has come and gone, not only will he have to pay tax on the $20,000 that I've been holding, which he already expects, but moreover, it blows the whole exchange. He will not have done an exchange at all, and consequently would have to pay tax on the entire amount of the gain from the relinquished property. That would be a disastrous result. And the second reason, besides the fact that it would affect him, if I were to disperse the funds to him before day 181, if he has another property on the list still identified, is the IRS could say, well, you know, that facilitator doesn't really pay attention to the law. And so we're going to audit the tax returns of all of those facilitators' clients, because if he doesn't follow the law, then he could just do whatever the taxpayers want. Whenever they want the money, then even though the written exchange agreement says that the taxpayer does not have the right to the money, if the facilitator just disregards the exchange agreement, disregards the law, and gives it to the client in one case, who's to say that the facilitator wouldn't do that in other cases too? And then therefore the IRS could go in and an audit of every exchange client of that facilitator and disallow all of those exchanges that have already happened, impose interest and penalties because the taxpayers in each case reported them as exchanges, when the IRS would come back later and say, well, no, we deem them not to have been because the facilitator that you chose is willing to just turn over cash at any point in time despite the fact that the law requires him to hold it, and despite the fact that the exchange agreement requires him to hold it. So it is a trap for the unwary, and it just shows you that when you're out there trying to choose between facilitators, make sure that you feel comfortable with the facilitator who you are working with. Because after all, the most important thing for you is that the exchange gets accomplished completely and finally. And once you have filed your tax return, you want to make sure, have some assurance, some certainty, some knowledge that nothing is going to come back and bite you from the standpoint of your facilitator's conduct is concerned. I'm Jeff Helston. If this has been a valuable video for you and you would like to learn more, please pick up the phone and call me. My phone number is 866-309-1031. Thank you.